ask her to make her contribution. Thank you, Minister.
Thank you, Cathaoirleach. And I appreciate the opportunity to speak on the Finance Bill 2023, which has been passed by the Dáil. This bill is relatively short and provides for some of the cost of living measures announced by the Government in late February. The full package of measures will cost €1.2 billion and will put money back into people's pockets, help with bills and ensure that there is no cliff edge for the temporary measures already in place. The Government has acted repeatedly and on a significant scale to address the cost of living challenge that we've experienced. Over the past year, Ireland has experienced a broad-based surge in inflationary pressures, leading to higher prices for households and businesses alike. The key driver of these pressures, obviously, has been Russia's illegal war in Ukraine. The Government appreciates the difficulties families face, and that is why significant measures, including and outside of the annual budgetary cycle, have been implemented in a real effort to try to protect households and businesses from the impact of these costs. We are in a position to help mitigate some of these price increases because of the prudent management of public finances to date, and it is important that we take that opportunity to support people when and where they need it. I'll use my time here this afternoon to concentrate then on the measures contained in the bill. A number of these measures are already in place, with financial resolutions giving them temporary effect, having been recently approved by the Dáil, and I think that illustrates the urgency with which Government views the measures, and I'll go into that in a bit more detail later. So the bill itself, this finance bill is very short, consisting just of 8 sections. Section 1 and 2 deal with a temporary change in benefit in kind regime for vehicles, and I know that that is a matter that senators raised at an early stage in this year, recognising that this change that was signalled some years ago came into effect at a very difficult inflationary period, which was not anticipated at the time that it was brought in, with the lead-in period of 3 years. Of course, the Government remains committed to the environmental rationale behind the current emissions-based vehicle BIK regime, which has been in operation since January 2023. But as I said, in the current inflationary context, the Government recognises the very practical difficulty experienced by some people facing BIK increases under the new regime. So to that end, and recognising that, these 2 sections provide for temporary changes to BIK for the current year, which will help to mitigate some of the increases associated with the new emissions-based calculation. So they introduce a relief of €10,000 to be applied to the original market value of cars in category A to D in order to reduce the amount of benefit in kind payable, and that is not applicable to cars in category E. The upper limit in the highest mileage band is amended by way of a 4,000 kilometre reduction, so that the highest mileage band is now entered into at 48,001 kilometres. And these temporary measures will retrospectively be applied from the 1st of January 2023 and remain in place until the 31st of December 2023, providing, I think, targeted support for people at a very difficult time without diluting the overwhelming environmental rationale to make sure that all of our motor taxes are emission-based, with a very strong focus on the environmental rationale for that. Sections 3 and 6 deal with agri-tax reliefs. Senators will be aware that a number of agri-tax reliefs were introduced or extended in the Finance Act 2022, but it was only possible to provide for them to the end of June this year at that time because the revised EU agricultural block exemption regulation had not been agreed. The new regulation came into effect then on the 1st of January 2023. Section 3 provides for the extension of farm restructuring capital gains tax relief to 31st December 2025, the extension of young trained farmer stock relief to 31st December 2024, the extension of registered farm partnership stock relief to 31st December 2024, the extension and amendment of the publication requirements of the accelerated capital allowance relief for capital expenditure on slurry storage to 31st December 2025, and the amendment of the publication requirements for the accelerated wear and tear allowances for farm safety equipment. The amendment of the publication requirements is necessary under the requirements of the revised ABER. That's the regulation I referred to, obviously. Section 6 deals with 2 reliefs provided for in the Stamp Duties Consolidation Act 1999. It provides for the extension of the Farm Consolidation Stamp Duty Relief and the Young Trained Farmer Stamp Duty Relief to 31st December 2025, and for the amendment of the period during which an individual can qualify for this latter relief after acquiring land from 4 years to 3 years to comply with Article 18.6 of the revised regulation. The sections also provide for transitional arrangements for the coming into effect of those changes. Section 4 provides for the phased restoration of the rates of excise on petrol, diesel and marked gas oil that will take place in 3 stages over the coming months, as announced on 21st February. This will see rates restored on 1st of June by 6 cent per litre of petrol, 5 cent per litre of diesel and 1 cent per litre of marked gas oil. On the 1st of September, those rates will increase by a further 7 cent for petrol, 5 cent for diesel, 1 cent for marked gas. Rates will then be fully restored on the 31st of October with a final increase on 8 cent for petrol, 6 cent for diesel, 3 cent for marked gas oil. The extension and phased reintroduction of these excise reductions is estimated to cost €383 million. Those changes have already been introduced by financial resolution and approved by the Dáil. I would like to note that oil prices have fallen back in recent weeks, and certainly I see, and I imagine senators and anybody watching see, that prices at the pumps have reduced considerably. Indeed, they're at their lowest level now since September 2021, so this will mitigate the effect of these increases. Section 5 deals with VAT changes, some of which have been introduced by financial resolution on 22nd of February. The section provides for the extension of the 9% rate of VAT on the supply of electricity and gas until 31st of October 2023. It also provides for the extension of the 9% rate of VAT on the supply of certain goods and services in the hospitality and tourism sectors until the 31st of August 2023. It also provides for the continuation of the application of the zero rate of VAT to the supply of COVID-19 testing kits. Finally, this section also provides for the zero rate of VAT to the supply and installation of solar panels. At the request of the Minister for Environment, Climate and Communications, the Minister for Finance, Michael McGrath, agreed to the zero rating of VAT for the supply and installation of solar panels for households and private dwellings. I believe it's a very welcome measure. If passed on to consumers, the Department of Finance, estimate that it would reduce the average cost for such supply and installation for consumers from €9,000 to €8,000 and would support households in reducing their electricity bills into the future. And I would encourage the passing on of this reduced VAT rate to households in every situation. A financial resolution to give this amendment legal effect from the 1st of May 2023 was passed by the Dáil last week. The measure underlines the government's commitment to help households to save money on their energy bills, reduce their carbon footprint and contribute positively to our national climate change targets. The estimated cost of that measure for the Exchequer is €19 million annually. Now, I've already spoken about Section 6 with Section 3, as both sections deal with agri-tax reliefs. Moving on to Section 7, which deals with the Temporary Business Energy Support Scheme, the TBES, which was announced in Budget 2023. To date, 35,613 claims have been approved under the scheme with a total value of €77.6 million. Revenue are publishing comprehensive information on the scheme on their website. A motion agreed by the Dáil on 22nd of February approved a number of draft orders. These extend the TBES to the end of April. The monthly cash cap was increased from €10,000 to €15,000 for a business with a single premises, and from €30,000 to €45,000 for business with multiple premises, and those changes took effect from the 1st of March. The TBES is provided for in sections 100 and 101 of the Finance Act 2022. Section 7 of this bill, however, will amend Section 100 of the Finance Act 2022 to provide that the Minister for Finance may make a ministerial order extending the scheme to a date not later than 31st of July 2023. And Section 101 of the Finance Act 2022 will also be amended by this bill. So firstly, the scheme will be extended to the 31st of May 2023. The scheme was due to end at the end of February, 28 February 2023. However, following exercise of the power contained in Section 100 of the Finance Act 2022, the Minister extended the scheme to 30th of April 2023, which was the latest date provided for in the legislation. So this further extension to 31st of May will help businesses deal with the continuing impact of higher than energy costs, and the power to extend to 31st July will provide flexibility to further extend the scheme if it is considered appropriate. Secondly, the energy cost threshold is being reduced. Currently, in order to be eligible for TBES, a business must have experienced a 50% increase in the average per unit cost of electricity or natural gas relative to the reference period. Now, this is being reduced to 30%, and that change will be applied retrospectively from the 1st of September when the TBES was commenced. Thirdly, the amount of relief that a business will receive is being increased. Currently, a business is entitled to a payment equal to 40% of the uplift in its energy costs, and from the 1st of March 2023 this will now increase to 50%. And finally, the bill now provides for a new time limit for making claims under the scheme, which will be 2 months from the end date of the scheme. It had been previously 4 months from the end of the claim period to which the claim relates, so this basically gives businesses further time and flexibility in which to make a claim. And the intention here is to deliver more money to those businesses that have suffered as a consequence of higher energy prices. Some businesses have suffered more than most. I think in particular about butchers and the particular threat that they had as a consequence of having to refrigerate meat during a very difficult and warm period and during a warmer winter. And it's important that we respond with the flexibility that businesses need to be able to continue to manage their costs. But we are aware, as the senators are aware, that the amendments to the TBES scheme were subject to state aid approval, and provision was made for a commencement order to give effect to the amendments when such approval was received. So that approval was received, and I would take the opportunity and encourage senators to take the opportunity to encourage businesses in their areas to join the over 28,000 businesses who have already registered for the scheme. Revenue have advised that with effect from last Monday, 17th of April, qualifying businesses can submit claims on Revenue's online service, ROS, for the March and April claim periods. And from this week, 24th of April, it will begin reassessing claims already submitted for the period from 1st of September 2022 to the 28th of February 2023, which did not meet the original 50% energy cost threshold, but now qualify under the 30% energy cost threshold. So that means it won't be necessary for a business to have to go to the trouble and expense of revising claims already submitted for those periods. Revenue will do it for them, and once reassessment has taken place, Revenue will notify applicants. So we really are trying to make it as easy and practical as possible for businesses right around the country who have submitted claims to in fact get more money now to support them without having to go to the trouble of making a new claim. The final section of the bill, obviously, is the standard one dealing with the short title. So, as I said at the outset, this is a short but important finance bill. I do look forward to constructive discussion in the House and to hearing views of senators. The bill provides for a number of targeted tax changes and specific measures to support families and businesses, and I do commend the bill to the House. Thank you.
Thank you, Minister. I'd like to welcome the